Hello, welcome to a brand new episode of Inside Exchange with me, Nikhil Ananda. And this week, we're going to be talking about indices. Now, there's a whole bunch of people out there who've heard of terms like Nifty or Sensex or small cap and mid cap, but are wondering what exactly it is that they really mean. Now, if you're one of those, then stay right there with us for the next half hour because we're going to be deconstructing indices for you and telling you why they're so important. Joining us today, Mr. Dhirendra Kumar, who is the founder and chief executive at Value Research, Monica Halan, consulting editor Mint, and also a consultant at the National Institute of Public Finance and Policy, and Sajeev Dhawan joins us from JV Capital Services. Thanks so much, ladies and gentlemen, joining us, all of them from our Delhi studios. And ma'am, if I can begin with you with a very simple question. What exactly is an index? Can you explain the concept to us?
For a very, very lay investor, an index is just an instrument to measure something. So you can have an index on anything. You can have an index on a stock market. You can have an index on prices. Like we know of the consumer price index. We know of the wholesale price index. You even have indices on corruption or on social indicators. So when you have something which you want to measure, like a market or say corruption, you need a metric. So you use the concept of an index which takes a representative sample from a universe of say stocks and then builds a metric so that you can measure it. So it's essentially a tool for measurement, right? So when people think of an index, they just think of the stock market, but actually you can have an index on anything.
Right, but you know, so from what I've gleaned from what you said, a stock exchange essentially gets some stocks that are selected and grouped together to form an index. But what is this classification done on the basis of, Mr. Kumar?
As Monica said, that an index is an aggregation of a homogeneous set or a sampled from the universe. So this is basically, index should generally be representative of the overall mood. What you're trying to figure out is a broad index should be reflective or should be a truly true reflection of whether the market has gone up or not. So what happens here is, prominent companies from the market. The listed universe in India is 4,500 stocks. So how to measure it based on a sample? So Nifty is basically 50 stocks, which is reflective of the market mood. Likewise, we have various index reflecting the different constituents or the components of the market. We have the small cap, so looking at small cap universe, or the mid cap or the large cap, or different different sectors. There are also many themes on which these indices are mounted. So trying to gauge the mood of various component of the market or the overall market. That is how it is all devised and constructed.
Right. And does the value or the composition of an index continue to fluctuate, Mr. Dhawan? And what does that happen on the basis of? Because you often hear of the Nifty going up 100 points or going down 100 points. What does this happen on the basis of? And does the composition of the index also change in terms of the 50 stocks that are there in the Nifty? Are they sacrosanct or do they change from time to time?
Well, changes can happen from time to time, and we've just seen some changes over the last couple of weeks. That's decided by some rules which are preset by the SEBI and the exchanges. So that is not sacrosanct at all. The benefit and the composition is basically the market cap of the stocks and the free float. And each stock in the Nifty, for example, there's 50 stocks, would have a weightage. So as the markets move up or down with those stocks, they would give a weightage to the whole basket of 50 stocks. So if Reliance, for example, went up one day by 5%, that might add to plus 20 points in its weightage. If other stocks went down, that would give a negative reaction. And it's a total of those 50 which would make the indices go up or down, whether it's 50 points, 100 points, and obviously on the downside. So it's important for investors and fund managers, and obviously for the sentiment of the markets to see which way the general trend of the markets are.
Right. Ms. Halan, can you give me a snapshot of the various types of indices that we have in the Indian equity markets? And from a retail investor standpoint, what are some of the safest bets if I just want to put my money into an index?
So I will not even use the word bet. because in my investment philosophy, we don't bet on a market, we invest in a market. So a small correction there, we will talk about investments and no betting here. I think let's just first focus on the broad market index. So you can have, as I said, an index on anything. So the broadest index that we have is the Nifty and the Sensex, where you will pick the most representative stocks. And what does that mean? It captures about 80 to 90% of the value of that market. And on an average, the price movements will cancel out. Right? So for an average investor who's looking to invest for the long term, we believe that equity is one of the best asset classes which takes care of inflation and taxes the best. So the best way for a retail investor to invest long term will be through a broad market equity index. And one of the reasons to do that is also because it costs very less. So you can have different indices. You can have an index on the banking stocks. You can have an index on technology stocks, on pharma stocks. These are all sector. You can have an index on debt products, on corporate bonds. So you can slice the market any which way. For the purpose of a first-time investor, you should stay with index investing in a broad market index. So that's really the message for investors.
Right. I want to understand the advantages really of grouping all of these stocks together. Of course, apart from giving us a overall sentiment to the market, what are indices really used for?
I think just to understand the health of a market. So when you want to gauge a price movement, you want to gauge what has happened today in the market, the index becomes the vehicle to do that. Right? So it's a measurement metric. I mean, let me just put it as simply as that. When you want to gauge, so again for the retail viewers, I mean for the people who are viewing this channel, when you want to taste a dish, you will pick out a spoon and taste it. Right? So you are not going to eat the whole thing to taste it. So it's a way to taste the market. What has happened today in the market? And the average price movements will cancel out and you will get the dominant price movement of the day. So very, very simply, that's what an index does.
Right. Mr. Kumar, we of course have, benchmark indices. So you have the Nifty, which is made up of 50 stocks. You have the Sensex with 30 stocks. But can I, as an investor, as an informed investor, create my own index?
Yes, you can always create your own index and you can have your own thinking, but you'll have to maintain it and you'll have to, devise a methodology doing it. The basis of it, and if you have some thinking, and there are some custom index, and there are some custom index on which some mutual funds are mounted. They are not generic mainstream indices. For example, we have the Nifty, which is weighted in a certain manner, the top capitalized and based on the free float and the scale of the capitalization of the company. But we have some modified indices like that. There is a fund in the market managed by Motilal Oswal, which is actually an equal weighted index, or something which is, that on many occasions does better, because the indices that we have, they are not equal weighted. They are weighted in relation to their free float capitalization. So Reliance or HDFC Bank is the highest capitalized company in the Nifty. You can create your own index, but then you'll have to maintain it. You'll have to devise the methodology, and that's not an easy way for participating. Also, I think that we have to see index investing is not very popular in this country. It's beginning to, and if you just want to get the return which is generally available in the market, index investing is a very easy way to achieve that. You will do no better, no worse. You will just be able to match the return of the index, maybe sometimes more, because many of these raw indices are not dividend, it does not assume dividend reinvestment. So it's possible to, marginally beat the index by doing an index investing sometimes. And it's an easy way to actually invest in equity.
Right, and we'll talk in more detail about index-linked investments in the second segment. Before that, Mr. Dhawan, how do I derive the value of an index? Is there a science behind it? When I say Nifty at 8,200, how do they arrive at that figure?
Well, that's a calculation, as I said earlier, that all the stocks will have their weightage based on their free float. So there will be a base effect, which was when the NSE on the Nifty started at, say, 1,000 levels. Today it's near the 9,000 levels. So the value of those stocks with their market cap, with their weightage and their free float would have gone up. That's all calculated together, and that reflects in the current prices. So on any particular day, that calculation is done. And there's a divisional factor which might get a bit confusing, but there's a multiplication formula there. And that is what reflects on the day-to-day basis, which gives the closing rates and the second-by-second rate, which you'll see on the indices on a day-to-day basis. But I don't think it should be of the concern to the average investor. It's more the direction and the composition of the indices. And as been mentioned, there's many types of indexes which investors and traders can follow and use to benchmark their own portfolio investments.
Right. And before we take a break, what are some of the world indices that investors should know of? And can I invest in any of those, or can I just put in money into the Indian stock market or the Indian stock indices, Mr. Dhawan?
You can invest globally. You've got the Dow Jones, you've got the European indices, where it's the FTSE in London, the DAX in Germany, and the French CAC. So there's many indices all over the world. In Asia, the rules regulated by SEBI will allow you to invest in certain funds, probably exchange-traded funds, which allow you to partake in that. It's a good way to spread your investment risk, especially if you're bullish on countries abroad. You've seen the US markets go significantly higher. So if you had an index fund which was focused on the US stocks, you'd have got very good returns over the last few months. The same goes for Europe. So if you have that ability to invest abroad, you can consult your advisor, whether it's your broker or your mutual fund advisor or even your banks, and I'm sure they'll be able to guide you how you can remit some funds abroad and partake in that.
All right, now that we've understood what an index is, we'll dig a little deeper into the simple index-linked products that you can put your money into as an investor, but that's after a quick break. Stay tuned.